And now this today's one more session on indirect tax of GST is going to be one of the most important aspect of the GST law, being the input tax credit. All of you are aware that in service tax as well as in VAT, the input tax credit is like a heart of the entire law, and the entire proper functioning of the law and implementation of law depends on the smooth sailing or the appropriateness of the input tax credit granted under the law. In this webinar, we have with us today Mr. Bharat Shemlani, a renowned faculty and one of the very few chartered accountants who is practicing on VAT as well as service tax. You are all aware that in the new GST law, major part of the input tax credit has come from the VAT law. Some of the disallowances have also come from the VAT law, and some have come from the excise law. And that's why we have the benefit today of Mr. Bharat Shemlani, who practices in VAT as well as service tax. He is one of the leading speakers on GST law. He has already spoken on various forums, including WIRC, the Western India Regional Council of the Institute of Chartered Accountants of India, who has held a lot of seminars with respect to the first draft law which has come in, and also with respect to the second draft law. To formally introduce, he is a practicing chartered accountant having more than 21 years of experience. He has authored various books on service tax, including basic concepts and procedures of service tax on behalf of the Bombay Chartered Accountants Society. He has written a book on cooperative housing society, service tax aspect, which has been published by the All India Federation of Tax Practitioners. He has also written a part of the writer of Service Tax Overview Handy Guide for Tourism, Hospitality and Entertainment Industry, published by the Malad Chamber of Tax Consultants. Apart from this, he has been a regular speaker on almost all the forums across country, as well as in all the forums of Mumbai region, like the Bombay Chartered Accountants Society, the WIRC, the Chamber of Tax Consultant, and the All India Federation, Sales Tax Practitioners Association. I think there are hardly any organization where he has not spoken for. Apart from that, he is a regular contributor and has written various articles in various journals of the STPM, CTC, etc. With this brief introduction, I would now request our treasurer, Mr. Parag Ved, to present a memento to our today's speaker, Mr. Bharat Shemlani, as a mark of our respect towards him. Over to Bharat bhai.
Good evening, friends. At the outset, let me thank the CTC for giving me an opportunity to share my views on the ITC and the nice introduction given by the Vikram bhai. The ITC is the backbone of the GST law. But before that, if you see the slide, once you stop learning, you start dying. That is what the Albert Einstein said. This is the second revised model GST law, and we already had one GST law in June, second now again in November. So for professionals, for consultants, it's every day is a learning process, And if you stop learning, you will start dying. And it is like, the learner's license we are having when we learn the car or something like that. So it is always a L on the back of ours. With this brief thing, I'm going to take today ITC on inputs, input services, capital goods, ITC in respect of job work, ISD, and related transitional provisions. As I said, ITC is the backbone of the entire GST law and the one of the most important components, because if the ITC is not there, then there won't be any GST, because ITC stands for input tax credit. Whatever you pay on the purchases or on receipts is allowed to you against your output. Before going into the scheme of ITC under the present model GST law, let us go through what is the present SENVAT and set-off eligibility. The present SENVAT and set-off eligibility is SENVAT, is under the SENVAT credit rules. Set-off is under the VAT rules. So nature of tax is excise duty is levied on goods. The credit is available only to manufacturers and service providers. Additional special custom duties is on goods again. It's available only to manufacturers, not available to service providers. Service tax is on services available to service providers and manufacturers. VAT entry tax is on goods available to manufacturers, traders. CST entertainment, luxury, LBT, octroi, it's on goods, entertainment, luxury, and is not available to any person. Now, if you see the dichotomy is here is that if you see the excise duty is not available to traders. If you see this special additional custom duties, it is available only to manufacturers. Service tax is available only to service providers and manufacturers. It is not available to traders. VAT entry tax is not available to service providers. So the credit is not available across the board to the dealers or to the assessees. And CST, entertainment, luxury, LBT, octroi, it's not available to any person. So ultimately, it is going to increase the cost of supplies. The cascading effect is not avoided thereby. Then in VAT, there are artificial reductions also, like for transfers to the outside the state. The 4% reduction is provided in the Maharashtra value. I'll refer to Maharashtra value tax because I know much better the provisions of those things, and it is generally applicable to other state also if the set-off is available. So like if you transfer your goods outside Maharashtra or outside the state, transfer to your branch or to consignment agent or to agent, then some artificial reduction is provided 4%. That much amount of set-off is not allowed. Similarly, on fuel, some 3% reduction is provided under the Maharashtra value tax rules. For office equipments, again 3% reduction. So basically, if you are paying 12.5 to your supplier, you are entitled to claim only 9.5. 3% is kept by the government as a reduction. Now these kind of reductions are provided in the VAT rules. Similar kinds of reductions are not there under SENVAT. So this is a current provision of the set-off and SENVAT under the present regime, VAT rules and the SENVAT credit rules. Now, if you are going into the present SENVAT set-off and the current ITC, so all these central excise duty, additional excise duty, service tax, additional custom duty, that is the CVD, and SAD, they are all subsumed into SGST, CGST. So all some 5 taxes are subsumed into CGST, that is one tax now. Similarly, under the state act, sales tax, entertainment tax, octroi, entry tax, purchase tax, luxury tax, taxes on lottery, betting, gambling, they are all subsumed into SGST. So instead of claiming taxes, like as I said in my earlier slide, that the trader is only entitled, or manufacturer is only entitled to claim the set-off of sales tax. He is not entitled to claim the set off of entertainment tax, octroi and entry tax, or luxury tax, or taxes on lottery and bad. Now, because of the subsume of this into SGST, every assessee is entitled to claim the entire taxes paid as a SGST. And IGST is nothing but the combination of these two. That is, if the CGST is 9 plus SGST is 9, then 18% will be IGST, which is levied on the interstate supplies of goods or services. So basically, taking 5 taxes clubbed into one, so now you are under the GST regime, you will be entitled to claim CGST and SGST straight away. So now what is the pressure? What will be the scheme of ITC under the GST law? As you are hearing now, it's often quoted that is a seamless credit. Seamless is without any hindrances. It's a seamless credit without any disturbance. How far that is there seamless, that we will see when we will go through our presentation. Now, if you see the nature of tax is on CGST, SGST, IGST. All these taxes are levied on goods and services, and the credit is available to manufacturers, service providers, and traders. Now, there is a difference between the present law and the GST, because the GST is available to on goods and services, and it is available to manufacturers, service providers, and traders across all the assessees without any restrictions. To give an example, a service provider was purchasing goods, not the goods which are sold and all these things, they're not inputs, but the example of say consultant. If a consultant, as a consultant who is paying a tax on his services, if he is buying any good stationeries or leather things, he was not entitled, or computers or printers, then whatever VAT paid, he was not entitled to claim the credit of those things. It was a cost to him. Similarly, a trader who was paying rent for his rented premises, either his shop or his godown or whatever it is. In such cases, he was not entitled to claim the credit of service tax paid on those rent, or if he is using any telephone or a mobile, then any service tax paid at 15%, he was not entitled to claim any credit of those things. Now, because of this GST, he is entitled to claim the credit of rent and other tax, rent and other GST paid on the rents and all the services, whichever services he are using for the furtherance of his business. So it is available across the assessees now. There is no bifurcation that this particular credit will be available if you are paying on goods, then only it is available to goods. So if you are supplying goods, then you are entitled to claim the credit of service GST paid on the goods. It is not that way. Even if you are supplier of goods, whether you are manufacturer, whether you are trader, still whatever GST paid on your services, you are entitled to claim the credit. That is a benefit which is there under the GST law. Dealers of exempt and non-taxable supplies and composition dealers, they are not entitled to claim ITC. It's a fair this thing, because ultimately if you are not paying on the output, then or at the output you are paying on some concessional mode like composition, they may be paying some 2% or 1% on the total distance. So in such cases, whatever inputs you are utilizing, for which you are not entitled to claim any ITC. Similarly, no credit is allowed on products not covered under GST, that is the petroleum products and the alcoholic beverages for human consumptions, for which no credit is allowed. Electricity duty, stamp duty, entertainment tax by local bodies, property tax, toll tax, etc. Now these kind of taxes, they are still not subsumed under the GST. So even if you are paying electricity charges and on which you are paying electricity duty to the electricity company, the credit is not allowed to you. Similarly, stamp duty paid on the real estate, office and all these things. So in office or factory building or whatever, if you are buying any real estate and you are paying stamp duty or registration charges, then in such cases, the credit is not allowed. Similarly, if you are paying any property tax on the immovable property and that same immovable property is rented out, then you are not entitled to. Right now under service tax, they allow the deduction for the property taxes paid. So that is not allowed now. So proper tax right now, if you see under service tax, there is an exemption allowed, but in GST we don't know whether the deduction or exemption will be allowed to proper tax or not. Toll tax, even if you are using any rent a cab or hiring of motor vehicle, then in that case, even if you are paying toll tax, that will form part of the cost of my rent a cab. And again, I have to pay on toll tax, again, I have to pay GST. So, still, it is not a seamless or one nation, one tax credit, what you are saying, one nation, one India, one tax. Still, there are some taxes which are not subsumed, and still, there are some taxes for which the credit is not allowed in its entirety. Now, one more thing which you have to understand is if you refer to the Senate credit rules, the Senate credit rules are delegated legislation. Similarly, VAT rules. If you see, each and every state is having their VAT rules, and VAT rules are set of rules, set of provisions are provided on the VAT rules. So it is basically a delegated legislation where the executive authorities, those who are administering, they have the power to amend the rules according to the amendments. The changes takes place. Like if you refer the Senate Gate rules, there are multiple amendments in a year. At least more than 10 to 15 amendments are carried out in a Senate Gate rules. Now, the Supreme Court in Maruti Suzuki's case, it has been held that it is very difficult to interpret the Senate Grade rules because it has amended so many times, and therefore there should not be any penalty for such cases. Now, that is what the Supreme Court has said. Now, if we take that same thing, now because the entire scheme is embodied in the Act itself, that is a GST law, whereby what I presume is that it will be amended only once in a year because it's an act. It has to go to the parliament for amendment. So we won't find any multiple amendments carried out throughout the year. Secondly, this is a one nation, one tax, unified tax, one India, one tax. Right now, we are having 31 constituents, 29 states, 2 union territories, 1 center, so 33, 32 are there in totality. Now, if everybody is given a delegation to change their rules according to their own whims and fancies, then there will be chaos. Because everybody will change the rules according to their own whims. Some states will allow ITC on some products, some states will allow ITC on other products, some will provide some restrictions, artificial restrictions, creations, and all these things. Now, to avoid all those things, the entire scheme is put into the Act, and thereby I think it will be, I think it's less prone to now amendments, at least that we can see. Now going to the scheme of ITC as such, we will go through the first major definitions. The capital goods definition, it is saying that goods, the value of which is capitalized in the books of accounts of the person claiming the credit and which are used or intended to be used in the course or furtherance of business. Now, if you compare this with the present Senate credit definition or even the first model law definition, it was almost a one-page definition, capital goods. Now they are reduced to only goods. Earlier they have specified the chapter numbers. Certain chapter numbers were allowed as a capital goods only. Now it is said the goods, the value of which is capitalized in the books of accounts of the person claiming the credit. So if you are capitalized the value of any goods, it will be treated as a capital goods, and accordingly the credit will be allowed to you. Now the question is, and it should be used in the course of furtherance of business. There is no qualification in the definition that it should be used in the premises of supplier or place of business. Nothing is there. So that means there even the physical barriers are not applied in such cases. The second thing is the books of accounts. Now which books of accounts? Because as we know, there are two types of books of accounts are maintained by the assessees, certain assessees, not all the assessees. Some are like corporates. They are having company accounts as well as the accounts as per the Income Tax Act. Now, if certain goods which are capitalized in the company accounts, the credit may be taken on the basis of the capitalization, or certain goods are taken as a revenue in capital books accounts maintained as per the Company Act. But in the income tax, when the books of accounts are maintained, they are treated as a capitalized items. In such cases, the issue will arise because you already claimed the depreciation, already claimed the credit on that according to the capital goods criteria. Now, if subsequently that goods are non-capitalized, then there will be some mismatch into the credit claim. But so we have to be very careful. I don't. That will be clarified in the future also. Which books of accounts maintain, either under the Company Act or under the Income Tax Act. So that's going to be the issue which will come up in the future. Otherwise, by and large, all the goods which are capitalized, it is allowed as a capital goods. A very short and a very sweet definition. Nothing, no qualifications are there as such. No means, no inclusions, no exclusions are there. So by and large, it's a very simple definition of capital goods. Then the inputs, again a very short and very sweet, just two-line definition. Any goods other than capital goods used or intended to be used by supplier in the course or furtherance of business. So if it is a goods not other than capital goods used or intended to be used in the course or furtherance of business, it's a input. Only condition that it should not be a capital goods, because capital goods you are claiming under as a capital goods, and it should be used in the course or furtherance of business. Now, if you compare this also with our present uh, present definition of this inverted credit rules, again it's a very, in a general language, I don't know what restrictions they will impose, because they are not said ki any restrictions which will be imposed by the under the law, under the rules or something like that, which was there provided under earlier. Ki any any law earlier input definition, they said it will be some restrictions will be imposed by the rules or in the prescribed manner. So there are no such kind of things. It's a very clear-cut definition as such. Again, input service definition. Now, if you compare this input service definition, just a two-line definition as per the PowerPoint. If you can put it into the 11 font, it will be only one-line sentence. Any service used or intended to be used by supplier in the course or furtherance of business. If you refer to the present input service definition, it starts with means, then it includes, then it excludes, and it is also amended almost 3-4 times. And there are so many inclusions, exclusions are there. Now, if you compare this with this, it's a very simple provision as such. So, any service used or intended to be used by supplier in the course or furtherance of business. Now, input tax credit, this is a new nomenclature used for against this INVAT and set off. If earlier, as I said, this INVAT is there for excise duty and service tax, and set off is the term used for the VAT rules. Now, instead of that, now there will be ITC. So, any IGST, CGST, SGST charge on any supply which are used or intended to be used for business, and tax payable under RCM, this will be claimed as a input tax credit. So, any charge you are paying, any taxes you are paying of IGST, CGST, SGST on the supplies, again, everywhere it is qualified by the word used for business. If it is not used for business, you are not entitled to claim any credit. Now, business, again, we will go through what is a business mean. And then tax payable under RCM. Like in present regime also, we are paying taxes under the reverse charge mechanism on manpower, rent-a-cab, works contract service, then legal services, and director fees. Now, all these taxes which the recipient is paying, that is also allowed, provided subject to the conditions provided in the ITC scheme. Now, coming to the scheme of ITC, input tax credit, every registered taxable person, that is RTP, shall subject to conditions and restrictions within the time and manner specified in section 44 be entitled to take ITC charge on any supply of goods or services to him which are used or intended to be used in the course or furtherance of business, and the said amount shall be credited to the electronic credit ledger of such person. Now, if you are seeing my presentation, these red words are their RTP. It's a registered taxable person. So unless and until you are registered taxable person, when you are receiving those goods and services, you are not entitled to claim the credit. If you are likewise, if you compare this with the present regime of service tax, right now even the unregistered service provider can claim the credit of service tax paid on the services which are used for providing output services. There are high court judgments on this count, M portal and all these things. But all these cases have held that even if you are not registered, still you are entitled to claim the credit. Secondly, it should be used in the course or furtherance of business. That is most important. And thirdly, it will be credited automatically to the electronic credit ledger of the such person. It's not like that you have to claim it. If the supplier is sending you the goods or services, he will directly show it as outward supply, which will become an inward supply to the receiver, and then it will go to his electronic credit ledger account, and he has to apply that whether he is entitled to claim the credit or not, subject to the conditions prescribed in the ITC scheme. So the most important thing which has to be remembered is now, if you want to claim any credit, you should be registered a taxable person. So if you are not paid tax because of any reason for 1 year, and thereafter suppose if the department comes to you and find out you are liable to pay the tax which you have accepted, then whatever services you have availed or whatever inputs you have availed, whatever capital goods input services, on those whatever GST you have paid for the last 1 year, you will not be entitled to claim any credit. But at the same time, you will be liable to pay GST on your outward supply. So not allowing credit is actually a retrograde step because it's a GST, it's a goods and service tax. Goods and service tax represent it's a value added tax, because if I'm receiving at 100 rupees and selling at 150, then on 50 rupees margin I'm paying tax to the government. And so basically I'm paying on the value addition. So 150 I'm paying say 10% tax, which is 15 rupees. And on 100 rupees, which is my input, I'm paying 10 rupees. So 15 minus 10, 5 rupees I'm paying to the government. And 10 rupees is my ITC. Now if you don't allow me the credit of 10 rupees, then I am liable to pay 15 rupees, and the 10 rupees is a cost to me. So that is going to create, so you have to be very careful. If your liability is there, you should register yourself. There are provisions, you can register yourself after crossing your threshold limit, or you can take voluntary decision depending upon the circumstances. You can go. But the most important thing which you have to remember is that you should be registered before claiming the credit, or at the time of claiming the credit. Now for capital goods, now this provision was not there earlier. I think this is a representation by on the transportation of liquid by the gas pipelines and telecommunication tower companies. So ITC in respect of pipelines and telecommunication towers fixed to earth by foundation or structural support, including foundation and structural support thereto, it shall not exceed 1/3 in the total tax input in the first year in which the said goods are received. So whatever GST is paid on the pipelines and telecommunication towers fixed to earth by foundation or structural support, and including foundation and structural support thereto, it will be allowed in a staggered manner for 3 years. 1/3 in first year, in the next year 2/3, 2/3 includes 1/3 of the first year, and in the last subsequent year the balance. So the entire 1/3, 2/3 and balance is allowed in 3 years. So instead of allowing it in 1 year, they have allowed it in 3 years. This is maybe the representation by, because immovable properties, the earlier draft law has said that no credit will be allowed on immovable properties, concession of immovable properties. So now maybe representation by this industry which has seen the light now. So all these two cases, pipelines and telecommunication towers, towers as such, and the structural support or foundation for that, the credit is allowable up to in 3 years, 1/3, 1/3, and balance in the last year. Now, apart from these two items, all other capital goods, full credit is allowed in the first year of receipt. If you compare this with the present law, which says that you are entitled to claim maximum up to 50% and the balance in a subsequent year. So, in the present law, the tax credit is allowed on capital goods in 2 years. Now it's in first 1 year itself. So that is a one major benefit, I think, because that will reduce the cost basically. So entire credit will be allowed in the first year itself. The most important is how conditions to claim ITC. Now, no RTP shall be entitled to claim the ITC in respect of any supply of service of goods to him unless he is in possession of a tax invoice, debit note issued by a supplier registered under Act or such other tax paying document as may be prescribed. So the most important condition, the first condition is that you should have a tax invoice in your possession or a debit note issued by the supplier or any other tax paying document that is the tax paid under the reverse charge mechanism. Now in those cases only the credit will be allowed. If you don't have the invoice in your hand, then the credit will not be allowed at all, because you should have the tax invoice. Now there is no, it's not that you should have a physical invoice, even an electronic invoice will do, because that is going to be the era now, digital era. So, and it should be a tax invoice. Bills is not of use, because bills and all this thing, because there is not of use. So tax invoice will show the tax separately, debit note the similar way, tax it will show taxable value and tax separately. Second is he has received the goods or services. Now this is the most important condition, receipt of goods and services. So you have to receive the goods and services. Now, if you've gone through the supply of goods and services, in that case, you have to pay tax on the advance received. So suppose if I receive the advance for goods and services in April 2017, then I have to pay tax on it in April only, though I have provided the goods to my receiver in the month of June. Now he will not get the credit in the month of April, though I have paid the tax to the government. He will get the credit only in the month of June. So that way the credit is deferred till the receipt of goods. Now, it's according to me, it's not a retrograde provision, because once I pay the tax, the credit should be allowed. But then this is the conditions they have put. Even in the revised draft law, they have said that when anybody is receiving an advance, he will not issue a tax invoice. He will issue a receipt voucher for that. Now, anyway, once you are paying a advance, what you will have in hand is a receipt voucher. You will not have a tax invoice. So you are not satisfying the first condition also. So otherwise also you are not entitled to claim the credit. And second, the condition itself is there that you should receive the goods. So, and I don't think there is a deemed receipt they have provided. Even the returns also, the GSTR 1 and GSTR 2, they have specific clauses itself. On the advances, how much tax you are paying. And whenever you will raise the invoice for such thing, you have to report it separately. So I think the whole idea is not to give credit on any advances, tax paid on any advances, only when the goods and services are received, and that point of time only the credit will be allowed. So if that receipt is forfeited and tax is also forfeited in that such cases, then no credit is allowed. It's a loss to that person who has paid the advance. The tax charge in respect of such supply has been actually paid to the account of the appropriate government, either in cash or through utilization of ITC admissible in respect of the said supply. This is most important condition, because this is picked up from the Maharashtra value-added tax. I can specifically say it is also available in other VAT rules also, VAT state VATs also. Whatever tax charge on the supply, it has been actually paid to the account of the appropriate government. Now, it is like that it is not that you have paid to him. That condition is also there. I will come to that in the subsequent slide, which was not there earlier. It was introduced in the revised law. But you have to ensure that the supplier has also paid the tax to the government, and that not to the government, it should be paid to the appropriate government, because so it has to be ensured that your supplier has paid the tax to the government, and then he has filed his returns also. That is also important, because if he has not filed his returns, he has not filed his outward supplies and returns, then you are not entitled to claim the credit. The appropriate government means if the transaction is CGS interested, then he should pay CGST and EGST. Suppose if he has treated it as an interested transaction and paid the IGST on that, then also it is not allowed as a credit. Then you have to ask for a refund, and all other mechanisms are there. So most important thing is that the supplier has paid the tax to the government, and you have to ensure that, because unless and until he has paid the tax, either through cash or through utilization of ITC, the credit, your credit is restricted, your credit is barred till that point of time. And the supplier, the person who is claiming the credit, he has furnished his return under section 34. Without filing the return, you cannot claim. Now this C condition, I will come once again when I will go to the next slide. Now, where the goods against an invoice are received in lots or installments, the RTP shall be entitled to credit upon the receipt of last lot or installments. Now, suppose if you are receiving the goods, suppose you are given the order in say 1000 kgs, and you are receiving say 100 kg first, then 300 kgs, and then 600 kgs. Then if you receive those goods 100, 300 and 600 in say 5 months, and 600 is the last installment received in the month of say from April onwards to September, then whether still you have received 100 and 300 in the month of April or May, your credit, you are entitled to claim credit only when you receive the last installment, that is in the September month, and that is on the entire 1000 kgs. So this is again I don't understand, because you are already paying the taxes on the removal of goods. The moment goods are moving, they are supplied to the receiver. The supplier is liable to pay the tax. Then why the credit is deferred? It's again difficult to comprehend, but that is what the provision is all about, and we have to go by what is the provision. So this is the most important condition which was not there in the revised law, which was not there in the first model GST law, but which is introduced now under the revised model law. This is presently also it is there, where a recipient fails to pay the supplier of services. It's only for applicable to only services only, not to goods. The amount towards the value of supply of service along with the tax payable thereon within the period of 3 months from the date of issue of invoice by the supplier, an amount equal to the ITC availed by recipient shall be added to his output tax liability along with interest thereon in the manner as may be prescribed. Now what this suggests is that if you don't pay to your supplier within 3 months from the date of issue of invoice, then whatever credit you have claimed, it will be automatically added to your output tax liability, and you will be liable to pay interest on that. Now presently also this provision is there, but interest is not payable for the 3 months. I don't know why they have introduced this, but this is what. So in effect, all service providers are guaranteed payment by this clause, because within 3 months, because if the supplier, if the receiver is not paying the supplier of services only, not goods, within 3 months of service tax of the services and the tax payable thereon, within 3 months, then he is not entitled to claim. Even and he is entitled, if he has claimed the credit, then he is liable to reverse that credit along with interest. So now you have to satisfy the conditions that first of all you have to supply, you have to pay to the supplier of services within 3 months, value of service along with tax thereon. So that is the first condition you have to satisfy. Then you have to satisfy that whatever amount you have paid to him, he has paid that to the government, and that to appropriate government. And third thing, which is not here, but then just by making payment of tax will not absolve you. He has to ensure that he has filed his outward supply, because once he filed his outward supply and he's filed his returns, then only it will become an inward supply to you, because his outward supply will become an inward supply to you. So without filing his outward supply and without filing his returns, again you are not entitled. So the entire duty is cast upon the person who is claiming the credit. First, he has to ensure that he has paid to the supplier. Secondly, the supplier has paid the tax to the appropriate government. Thirdly, he has filed his outward supplies returns and the normal returns. So it's basically the government is casting a very heavy duty on the suppliers, receiver of that the services or goods, whomsoever the person is claiming the credit. And I think that it has already been upheld by the high courts. The earlier provision, this provision is there for the in the service tax also. This provision is there, and I don't see anybody has challenged this provision in the present regime. So same will continue also. So it's a burden. It's a really onerous task on the person who is claiming the credit, especially for services. For goods, such condition is not there. For goods, only the condition is that the supplier has paid the tax to the government. So it's basically what my personal opinion is that the the person who is claiming a credit is really at an onerous task, and he is a deemed recovery agent because he has to deem recovery agent of a government even without consideration, because he has to pay his own tax, and at the same time he has to ensure that his supplier has also paid the tax to the government. So that is really creating a double duty on him, and he has to I think he has to keep one a department in his the, company or firm or whatever business to deal with such kind of suppliers, because every time he has to ask them whether the person is paid or not. Because if it is small volume, it's okay, it can be identified. But if it is a large volume, in such cases, it is very difficult to keep a track who has paid and who has not paid. So very difficult. But then this is what the provision is all about. We have to go by that, whatever is there in the law. Then with regard to capital goods, this provision is also there in the present regime also. If you have claimed a depreciation on the tax component of the cost of capital goods under the Income Tax Act 1961, then ITC shall not be allowed on the said tax component. And that is a fair provision because only one benefit is allowed. You cannot avail two benefits. So if you already claimed a depreciation, then you are not entitled to claim the ITC. If you have claimed ITC, then you are not entitled to claim the depreciation on the tax component. And the time limit is given now. This is the general time limit is there. A taxable person shall not be entitled to take ITC in respect of any invoice or debit note for supply of goods and services after furnishing of the return under section 34 for the month of September following the end of financial year to which such invoice or invoice pertaining to debit notes annual return whichever is earlier. Now I'll just explain this thing through an example. Suppose if you have forgot to claim the credit for the invoice raised on say 1st April 2017, then the maximum time by which you can claim the credit is 30th September. There is a return for 30th September. That is by 20th of October you have to file the return for 30th September 2018. So you have 19 months to claim the credit. So 30th September 2018 ka return which is to be filed by 20th of August October 2018, or the date of annual return, that is a 31/12/2018, whichever is earlier. Now it is very obvious that 30th September 2018 return, that is the 20th of October 2018 return only will come into first. So only in cases where the annual return is filed before 20th of October 2018, this clause will come into picture. Otherwise, in other cases, the only date which is applicable to you is 20th of October 2018. That is a return for the month of September 2018. Because you cannot go beyond that date, because whichever is earlier. So if you are filing your annual return any time after 20th of September 2018, then you have to include all those invoices in the September return only. And most important thing is that if you forget to claim any credit either on invoices or debit notes for a financial year say 17-18 by 30th September 2018, then that credit is lost, is lapsed. You are not entitled to claim that credit any time thereafter. So you have to be very careful while claiming the credit, and you have to ensure these timelines. But I think the institute has already represented on this. We have already made a representation on this. The date is not correct. You should either give some in between date, but then this is even the revised law also the same thing has come. So by and large, the date will be September 30th September 2000 of the next year. Now, apportionment of credit and block credit, where goods and services are used by the RTP person by the RTP, partly for the purposes of any business and partly for other purposes. The amount of credit shall be restricted to so much of the input tax is attributable to the purpose of his business. Now, it is said if it is used for business or for other purposes. Now, the question is, other purposes is a very general term. So, any credit which is used for other purposes, it is not allowed. Even if we have seen the definitions, in the definition also, the words, all the definitions are qualified by the word used or intended to be used for business. Here also it is very clearly said if it is anything is used for other purposes, then the credit will be restricted. Now, business as such is not restricted for providing any outward supplies only. Now, whether if I am like, I'll give the example. Suppose other purposes, what will have the other purposes? Suppose if having a cash surplus and I'm putting those cash surplus into as my part of the business strategy, I'm putting it into mutual funds. And on redemptions, I'm getting the gains or dividends or some gains on it or losses or whatever it is. And it says some income is there. Now, whether that income, whatever I earned, will form part of the other purposes, because to that extent whether my reductions will be there of the inward credit. Or suppose I sold some land which I purchased maybe 20 years back, and I purchased it at 1 crore rupees. I am selling at say 20 crore. The 19 crore gain which I earned in the year of sale, whether it will be that 19 crore will be treated as other purposes, and that will be compared with my business activity. My business activity may be having a 1 crore rupees. So 1 crore compared with the 19 crore, my entire 95% credit will be reverse because of this provision. So whether such kind of apportionments will take place, and definitely as I'll come through this other purposes and all these things, those will be the restrictions or the reversals will be generally applicable to all. That means they will have some general formula how to calculate the reversals, and which will be applicable to all. So definitely that is going to create a lot of problems, but that will be notified by them. Right now nothing has been notified, but other purposes is a very general term is used and it is very ambiguous, so they are going to create a lot of problems into this. Now, where the second condition is where the goods and services are used by RTP for effecting taxable supplies, including zero rated supplies under Act or under IGST Act, and partly for effecting exempt supplies under the said acts, the amount of credit shall be restricted to so much of the input tax as is attributable to the said taxable supplies, including zero rated supplies. Now, here provision, because on exempt supplies you are not paying taxes on the outward supplies, therefore whatever inward supplies will be there, which are inputs or capital goods used to provide those outward exempt supplies, the credit is not allowed. So you credit. Now exempt supplies will not include zero rated supplies. Mind well, exempt supplies are those only where nil tax is there. All exports, all deemed exports, all I think the deemed exports or any zero rated supplies which may be include even the sales to diplomatic missions and all these things, those also will not be considered as a zero rated supplies. They will be considered as zero rated supplies, but they will not be considered as exempt supplies. So fair provision that if it is saying that the credit is not allowed on the exempt supplies. But if you look at the economic point of view, the ultimately when you are exempting something, you are increasing the cost of that input exempt supplies, because the credits which is available on the inputs is not allowed to that person. So he is not passing on that credit to the receiver. So if you see in the economics this thing level, then it is not a good provision as such. But then this is what going on. We have seen this in all the earlier excise law or service tax law and VAT law. Okay, wherever then when we are not paying on the outward supplies, the credit is not allowed to that extent. Exempt supplies shall include supplies on which recipient is liable to pay tax on reverse charge and basis under Section 8. This is the very provision which says that exempt supplies shall include supplies on which recipient is liable to pay on reverse charge. So those who are providing reverse services which are liable under reverse charge, like manpower or rent a car or legal, now for them the credit will be the service will be treated as a exempt service. So they will not be entitled to claim any credit. Now this is a double jeopardy because at one end the person who is paying tax on these services is not entitled to claim the he is not entitled to claim the 20 lakhs rupees exemption, general exemption, the threshold exemption which is allowed. And secondly, for that supplier, this all supplies are treated as a exempt supplies. So even he is not entitled to claim the credit. So ultimately, he is going to increase his cost of his supply because he is not going to get any credit, and he is not even entitled to claim the 20 lakhs rupees exemption. So the government has indirectly has taken away both the benefits. They have taken away the threshold limit also, and at the same time they have taken away this ITC benefit also. So this is actually a retrograde provision for a small service providers because their services or their goods will be costlier or will be on a inflated cost will be there because of the non-availability of credit and non-availability of threshold exceptions. Now, a banking company or a financial institutions, including a non-banking financial company, engage in supply of services by way of accepting deposits, extending loans or advances. It shall have the same option to either comply with the provisions of Section 2, that is, they can claim on the actual basis, or they can avail month-on-month basis 50% of the eligible ITC on inputs, capital goods, and input services in that month. So this provision was not there in the original model GST law. It was introduced in the revise only. This provision is there in the current syndicated rules, where you are entitled to claim only 50% credit and 50% you have to forego because of the interest on advances, loans, or fixed deposit interest are paid. So the banking company is doing so many businesses which are not liable to GST, which may not come under the GST mechanism. And in such cases, the credit is it is very difficult to keep the track record of actual credit, and thereby they have been given the ad hoc deduction of 50%. Now the option once exercised shall not be withdrawn during the remaining part of the year. So they have the benefit they can claim on actual basis also, and at the same time they can go for 50% benefit also. Then the ITC shall not be available in respect of motor vehicles and other conveyances except when they are used for making the following taxable supplies, namely. So motor vehicles and other conveyances will include aircraft, helicopters, vessels, train, whatsoever, roads and all this thing, every conveyances. Now if they are used for making following taxable supplies, namely further supply of such tax vehicles or conveyances, or transportation of passengers, or imparting training on driving, flying, navigating such vehicles or conveyances. So if the motor vehicles and conveyances they are used for they are given again on a hire, or they are used for transportation of passengers, or if they are used for imparting training on driving, flying, navigating, then only the credit is allowed, ITC is allowed. Otherwise, ITC is not allowed. So for a consultant who is buying a car or acquiring a car to provide his professional services, he is not entitled to claim any credit. Or any company which is buying cars for their executives, they are also not entitled to claim any credit. But for goods vehicles, the same condition is not there. They can be taken, and there is no requirement that those should be used for transportation of for further transportation of goods, or they should be given. So a caterer, if they are purchased a goods vehicles, acquired a good vehicles, and used it for transportation of goods, they can claim the credit. Similarly, a courier company or a manufacturer, if they are buying goods vehicles, they can claim the credit of these things because there is no further requirement. So, credit is allowed to that extent. Then supply of goods and services, namely foods, beverages, outdoor catering, beauty treatment. The one more thing which I just like to point out on the earlier slide is that it is only the motor vehicles credit which is disallowed. Now in the present regime, if you see, motor vehicles credit is disallowed. There is no doubt about it. But apart from that, even the services which are availed in respect of motor vehicles, like repair, maintenance, insurance of a motor vehicle, those are also disallowed. Now, in the GST law, they have just excluded the motor vehicles as such. Any services which are related to that motor vehicles, like insurance or repair maintenance, there is no such disallowances provided presently at least under the revised model GST. Now coming back to the next slide is supply of goods and services, namely food, beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgery, except where such inward supply of goods or services of a particular category is used by RTP for making an outward taxable supply of the same category of goods and services. So if this food and beverages is supplied, and again it is supplied, that is input also food beverages, or input is also outdoor catering and output is also outdoor catering, then only the credit is allowed. Otherwise, credit is not allowed. Now, this is again a means they want to set up the nexus of the services. It is a one-to-one services. So if a beauty treatment is taken by the Jet Airways, the airline company, then it is not allowed to them. I don't know why this kind of restrictions are there. Because it is for ultimately for the business. Or any canteen facilities provided to the staff. Then also it is not even not to the staff, even to the business people, the business associate who comes to this office and all these things. For them also the facility is not there. Food and beverages, like if you are taking your delegates to your restaurant and if you are paying any service tax on those things, then that credit is also not allowed. Now I don't know why this kind of provision is being introduced. This is only allowed only when in case you are receiving the same service and providing also same service. So outdoor caterer to outdoor caterer, beauty treatment to beauty treatment. So such kind of things. So professional having a opening ceremony in his office, inviting so many people, his delegates, his business associates and all these things, and paying to the outdoor caterer for the dinner which is provided or for the food and beverages provided, he will not get a credit. Though this is a part and parcel of his business expenses, but the credit will not be allowed. So that is one thing. The membership of a club, health and fitness centers, that credit is not allowed. Being, I think they are treating it as a personal expenses, therefore it is not allowed at all. Rent-a-cap, life insurance, health insurance, except where the government notifies the services which are obligatory for an employer to provide to its employees under any law for the timing in force. Now only these three cases of services, rent-a-cap, life insurance and health insurance, where the government notifies that these are obligatory for an employer to provide to its employees, then only the credit is allowed. I, I think this is again the provision is also half-hearted because a canteen facility, suppose if the factory is there which is having more than 250 workers, then it is a must. Now that outdoor catering is not coming into this category. There are only three categories. So if as per the law, as per the Factories Act 1948, Section 47, if the canteen facility is to be maintained for more than 250 workers, and without that you cannot run your factory, then though it is a must for business, obligatory, but still you are not entitled to claim the credit because it is not coming under clause 3, but it is coming under clause 1, where there is no requirement that it should be obligatory on the employer to provide. Likewise, a rent-a-cap is also, so all BPOs and all these things, unless and until it is notified by the government, it is must to provide this facility, transportation facility, then only it will be allowed. Otherwise, entire expenditure on such rent-a-cap, entire services which are availed by the company will not be entitled to claim the credit. Taking the example of say any marketing company where all the executives are having extensive travel and all those things. So in order to avoid the vicarious liability of any accidental insurance and all these things, any employee, the company may cover themselves with the accident. Now in such cases, unless and until the government notifies that industry that it should be obligatory for an employer to provide its employee the health insurance or life insurance, then only it is allowed, otherwise it is not allowed at all. I don't know why this is provided, but then this is what the provision is all about. Travel benefit extended to employees on vacation such as leave or home travel concession. So any travel benefits are allowed to employees or their family members and the cost is paid by the company. Then on that cases, whatever services are availed, credit will not be allowed. Basically, if you see earlier, the all these cases were there where the all the services were qualified by the word personal consumption or use of the employees. Now those words have been removed. So there is no requirement that it should be personal use or consumption. Even if these services are provided and they are for business, still the credit will not be allowed because there is no requirement that it should be only for personal use and consumption of the employees. This is the most two important provisions which are picked up from the VAT laws. The earlier provisions you can see these are from the services angle. So they were picked up from the service tax, Shenward credit rules. These are the two provisions which says that worst contract service when supplied for construction of immobile property other than plant and machinery, where except where it is an input service for further supply of worst contract. So if you are constructing in a factory and you are availing any services of plant and machinery for construction, availing any services for construction of a immobile property other than plant and machinery, the credit is not allowed. Even if you are availing services separately, like for goods separate, goods you are buying separately and services you are buying separately, then also if it results into immobile property for his own account, then then also the credit is not allowed other than plant and machinery. So in other words, if you are buying any property or you are constructing a factory building for your own purposes, credit is not allowed at all. But a worst contractor who is doing the construction for other person, he is entitled to claim the credit of any taxes paid on the subcontract. Similarly, builders, developers, they are also entitled to claim the credit of any taxes paid on the worst contractor because they are not the final consumer. The final consumer is the customer who is not entitled to claim. So these two provisions disallow the credit to the final customer and not to the builders or developer who are basically not the final consumer of the services, but they are basically the conduit point. So builders, developers, worst contractors, they are entitled to claim the credit if the same is again provided. Now, the provision, as I said, these are picked up from the VAT laws. Maharashtra value VAT laws, similar provision is there. So worst provisions, but then still they are picked up. Now, but if it is one thing is there, it's only immobile properties which is excluded and construction of immobile property. So plant and machinery credit is allowed because that credit is not restricted. So movable plant and machinery, anyway it will not come here. Whenever the plant and machinery is immovable, that point of time only it will come under this clause. And then any more property, if it turns out to be plant and machinery, you are entitled to claim the credit. Now the earlier earlier first model GST law, they are not defined what was the construction and what was the plant and machinery. Now they are defined that also. So construction includes reconstruction, renovation, addition or alteration or repairs to the extent of capitalization to the said immobile property. Now again, the word here is capitalization. The moment you capitalize in your books of accounts any construction, then it is a immobile property and then therefore it is not allowed. So now again this will create an issue because in issues, there are a lot of issues will create on this because in the repair you might claim it as a revenue expenditure in your books of accounts. If that is claimed as a revenue expenditure, then the credit is allowed because it is not capitalized. But if your books of accounts, if one company say painting of a wall, if they capitalize that painting for say 3 years, then they capitalize it, they will not be entitled to claim the credit. But if other company just put it into the revenue expenditure, the same item, then they are entitled to claim the credit. So that is going to make lot of issues again, because if it is, and again which books of accounts which we have seen under the definition of capital goods. So there might some issues will crop up in future, but anyway that's a part and parcel of the life. So plant and machinery which was not defined earlier, means apertures, equipment, machinery, pipelines, telecommunication towers fixed to earth by foundation or structural support that are used for making outward outward and includes such foundation and structural support but excludes land, building or any other civil structure. Now earlier as I said plant and machinery was not defined, now they have defined plant and machinery. So it includes all apertures, equipments, machinery, pipelines, telecommunication networks, towers, which are already we are seen in the definition of capital goods, which is already there. Even the structural support which is created, which is structural support and the foundation which is there, that is also covered as a plant and machinery. Now there are issues because again it's a subjective term, plant and machinery. Very some people might even building also can be taken as a plant and machinery. They have said machinery, equipment. Now if suppose if any cold storage plant is there, or any building which in-houses that cold storage plant, whether it should be considered as a plant and machinery or not, again will be issue. Or any pharmaceutical industry which is having very sophisticated plant, having the very specified walls, specified doors, fire resistant doors and all these things. It is very specifically constructed for the plant only. Whether that building should in-houses that plant is to be considered as a building or it should be considered as a plant and machinery is issue. The whole issue arises because Senate credit is to be claimed by the assessee and not it is not granted by the government. So while claiming the credit you should be very careful that you are claiming it on a proper basis, because if you are not claiming it then the government is not going to allow you that credit. So while claiming it you have to be very careful. If you are in doubt, either you claim it and don't utilize it or ask to the government, whatever, they take a clarification from the government whether the same thing is allowed or not. But once it is not taken, it is lost because there is a time limit also. So you have to be very clear while claiming the credits. Then goods and services on which tax has been paid under section 9, that is a composition. Any goods and services on which tax has been paid under 9, that is composition, because the bill will be provided, because composition dealers are not paying taxes at a concessional rate. So therefore the credit is not allowed on those things. Goods and services are used for personal consumption. This is very general term, personal consumption. How this will be applicable in case of companies, private limited and public limited companies, because as such they are the artificial entities, there is no person as such involved, but then still it is provided the goods and services are used for personal consumption, the credit will not be allowed. Now the example here is I can just give a consultant who is called his client, it will be treated as his business call, but when he's calling on the same mobile, when he's calling his family, it will be treated as his personal consumption. Now you have to keep each and every logbook of your calls, each and every services like motor vehicles, if it is used for transportation of the family or for maybe for dropping children's, and then whatever anyway motor vehicles credit is not allowed, but then the services at present, at least you are as per the law, present law, you are entitled to claim the credit of certain services like repairs and maintenance to motor car insurance. Now those part of it is used for the personal consumption. Now, this is again going to be very subjective term, because how to decide this, whether section 37(1) of the Income Tax Act, which says that any expenditure used or expended fully for the business is to be treated. So normally in a tax audit report we disallow certain part of it, 20% for motor car expenses, 20% of telephone expenses. If such kind of disallowances are there, then to that extent my credit also will be disallowed to that extent. So that we have to be very careful, because personal consumptions, and even they will notify how to calculate this, because it is going to keep, like I have given the example of calls or motor cars or any other, because it's in case of individuals, partners, it is by and large it is a common that same goods or same services are used for personal as well as business also. How to keep a track is going to be a very big question. Company anyway, it's artificially created person. Nothing is personal as such. But then definitely the questions will come on the reversal of such cases. Goods lost, stolen, destroyed, written off or disposed of by way of gift or free samples. This is again a I can understand for the lost, stolen, destroyed, because in such cases, normally the goods are insured, so you get an insurance claim, so they don't allow you the double benefit. You can claim credit also, plus you will are entitled to claim this one damages also from the insurance company. But looking at the gift and free samples, it's again not going along with the law of value added tax, because my gifts and free samples cost is already included in my outward supply. So the credit, why the credit is restricted or credit is denied on gift on free samples. Free samples, without free samples, I cannot do my business. Like a pharmaceutical company, they have to give free samples to the doctors, or gifts. Usually gifts are this is a part and parcel of the business gifts. A business gift should be allowed. So I don't know why this is there, but then credit is not allowed to that extent. So ultimately, the free samples cost is included in my outward supply. Gifts cost is also included in my outward supply. When I'm paying GST on the entire amount, my credit, why my credit is restricted or reduced to that extent. So, but then what this is what the law is all about. Then any tax paid in terms of section 67, 89 or 90. So any tax paid under section 67, that is any tax is paid, not paid or refunded by reason of fraud, willful misstatements. So if any supplier of yours, he has not paid the tax for any reason, say, and thereafter suppose department has come to him and asked for a tax from him, which is proved that it is because of fraud he has not paid the tax, then if he asks you to pay the tax to him so that he can pay to the government, you will not be entitled to claim the credit, because it is because of fraud he has not paid and you are paying to him, so it will not be allowed to you. Confiscation of goods or conveyances and levy of penalty. So any cases confiscation of goods and conveyances and levy penalty, the credit is not allowed. Detention, seizure and release of goods and conveyance in transit. Now I don't understand if for some small infractions like some invoice is not there or like that, or some invoice signature is not there or some mismatch is there. In such cases, if the detention happens or confiscation of goods are happening at the border check post or wherever, so now in such cases my entire credit is denied. Now, that is again for such a infractions, minor infractions or procedural lapses, the substantive benefit should not be denied. But then this is what the provision is all about. If this is happening, the credit is disallowed. Central government or state government may by notification issued in this behalf prescribe the manner in which credit referred to above may be attributed. As I said, in personal consumptions or in other purposes or for the exempt supplies, the credits will be attributed. It is available only to the extent of your taxable supplies used for business. So that government will notify. Now this notification, which is not yet come, it will come when the GST law will come into effect. The most important that these notifications are general in nature. They will be applicable to all the assessees. So by and large, they will take care of almost everything, but it will be on a totality basis. So for some assessees it might be favorable, for some assessees it might be unfavorable. The availability of credit in special circumstances. Now these are the cases which are happening only when the GST law will come into picture. A person who has applied for registration under the Act within 30 days. So if you apply within 30 days, then whatever stocks you are having of inputs, in inputs contained in semi-finished and finished goods, you are entitled to claim the credit. So if you apply within 30 days, then whatever on that last day of that in which you are liable to pay the tax, on that last day the credit is allowed. Mind well, input services received prior to registration or inputs capital goods received prior to registration, the credit is not allowed. Secondly, you have to register yourself within 30 days from which you become liable. If you don't register within 30 days, then the entire credit will be lost. You will be liable to pay tax on the entire amount without any availability of admissibility of credit. Secondly, if you are taking a voluntary registration, then again the same thing, whatever the day on which you are taking a voluntary registration, before that day, whatever immediately preceding date, whatever stock is held in stock, finished goods, semi-finished goods or inputs, you are entitled to claim the credit. Again here, inputs and capital goods credit is not allowed at all. You are liable to claim only this much. In case the registered taxable person is ceases to be a composition dealer, that means he comes under the normal normal scheme. then whatever, whenever he is seizing, say on 30th June he is seizing to be 1st July onwards, he is start paying taxes under the normal dealership. And on 30th of June 2017, whatever stocks he is holding, he is entitled to claim the credit because he is paying the tax on the normal scheme. In these cases, they have also allowed the credit of capital goods also. In earlier two cases, the credit is not allowed of capital goods. In these cases, the credit is allowed on capital goods also. And the capital goods credit is reduced by the prescribed percentage because of the, if suppose capital goods is here for 2-3 years, then accordingly the credit will be reduced to accordingly. So that is a provision. Then similar provision is applicable to the taxable supply. The person who was supplying exempt goods and services, he becomes taxable from 1st July, say July 2017. So whatever 30th June 2017, whatever stocks he is having, that stocks he can claim the credit because he is paying tax on those supplies of the finished goods. Plus he is entitled to claim the capital goods also, similar to the composition dealer. Now this is again a good thing because they are allowed the credit of capital goods, which was not there for the normal dealer. So, and the capital goods credit again will be reduced by the percentage points or depending upon the usage of this thing. Now, in all the four cases, that is a registration within time of 30 days, voluntary registration, uh, composition dealer ceased to be a composition dealer or ceased to be exempt supplies, then in that case the credit is allowed within 1 year from the date of issue of tax invoice relating to such supply. Mind well, 1 year time limit is applicable only to these four cases, not to the general cases. General cases, the time limit is up to the 30th of September 2000 of the next year, or annual return, date of annual return, filing of annual return, whichever is earlier. For all these four cases, you can go back up to 1 year. So suppose if you are liable to pay, in case of my example, from 1st July 2017, then whatever inputs you are having of 1st July 2016 onwards, those only credit will be allowed. Anything which is prior to 1st June to the 1st July 2016, that credit, like 30th June 2016, you have some invoices. The credit will not be allowed at all because it is more than 1 year. Similarly, where there is a change in the constitution of a registered taxable person on account of sale, merger, demerger, amalgamation, lease or transfer of the business, with the specific provision for transfer of liabilities of the state registered taxpayer, it shall be allowed to transfer that ITC remains unutilized in its books of accounts to such sold, merged, demerged, amalgamated, lease or transferred business in the manner prescribed. So this provision is there under Rule 10 also in the present regime. Similarly, it is applicable here also. So entire credit will be allowed. Entire credit will be transferred to the new entity, provided it is with the specific provision for transfer of liabilities also. Availability of credit in special circumstances. So a person who is switching over from normal to composition, or from his products are become exempted by date, then what, since he is not paying any tax subsequently or he is paying tax under composition, whatever stocks he is holding on that day of the last day, preceding date on which his switchover takes place, or the date of such exemption, he is liable to reverse the entire credit, whatever inputs which are lying, and whatever credit which is thereafter is there, like some credit is there, then that will be lapsed. He is not entitled to claim the credit. Now this is again a retrograde provision because I have already availed the credit which you are aware is allowing me. In the VAT, there is no such kind of provisions. In the Maharashtra value added tax, they are allowing the refund of the entire amount. There is no such provision to lapsing the credit. The entire credit is allowed. So to that extent, it is a loss to that assessee because he has already paid the taxes to the government, may not be utilized the credit, but he is not entitled to carry forward that credit. The amount payable under section 7 shall be calculated in such a manner. So this amount will be calculated in the manner prescribed. The amount of credit under 1, 2, 3 shall be calculated in the prescribed manner, as I said. Then whenever you are transferring the used capital goods or plant and machinery, either as it is or after usage, then specific percentage, which are, this provision is presently also there under Senate Grade Rules. So 2.5% you are entitled to claim the credit, and balance 2.5% per quarter, so 10% per annum, and balance you have to reverse. So if you are using a machinery for 6 years, then for 6 years 60% of the credit is allowed to be availed, balance 40% you have to reverse. But if you are selling the same goods at a transaction value which is higher, and the duty component of that is very higher than the reversal value, then you have to pay the duty component. So whenever you are claiming credit on capital goods, you have to be very careful, because right, if you don't claim the credit on capital goods, this provision is not applicable to you. But if you claim the avail the credit on the capital goods, then whenever the said capital goods are sold or supplied basically, then in such cases either the reversal of credit should take place, or you have to pay the tax on the transaction value, whichever is higher. Now, where refractory bricks, molds, dies, jigs, furniture are supplied as a scrap, then if it is supplied as a scrap, then you have to pay on the transaction value. There is no need to go as a reversal. Now, this is going to, like, you, if you are taking the claim on the furniture, then this is going to create a problem, because furnitures and all these things, how you keep a track? Because if you use it for 10 years, which chair you have sold, which table you have sold, it's very difficult to keep a track. So it is better to, instead of claiming ITC, better to go for a depreciation. And depending upon the circumstances, you have to decide. Now this is talking about the job work. A principal, he can send the inputs directly to the job worker. Either he can receive to his place of business and then he can send it to the job worker, or he can instruct the supplier to directly send the inputs to the job worker without being first brought to his place of business. In such cases, whenever the goods inputs are sent to the job worker, then those should be returned within 1 year of their being sent from the date of supply. If they are not returned within the 1 year from the date of supply, date of input sent to them, to the job worker, then the input sent directly, it will be treated as a output supply, and they're liable to pay the taxes. Okay, so the whole thing is that if within 1 year, if the inputs are not received back, then the principal is liable to pay tax on that input sent, and secondly, he is liable to pay interest also, because the date of deemed supply will be the date on which inputs had been supplied to the job worker. Now it's very difficult. You have to keep a track of every input which has been sent. If you have not received the inputs within 1 year, get back those inputs within 1 year. If you know that the inputs will take some time, more than 1 year, then get back those inputs 1 year to your premises, and then again send it back, to avoid the interest liability. Otherwise, there will be huge interest liability, because 1 year you have to pay the interest. A similar provision is applicable to capital goods also. The principal may send capital goods to job worker for job work. Either he can send directly, or he can instruct to supplier to send it directly to the place of business without bringing first to his place of business. In that case, in capital goods, the time limit is 3 years. So within 3 years, the capital goods should come back to the principal. If they are not coming back within 3 years, then it will deem to be supply, and he will be liable to pay interest on that. Now again, this is a provision which is after 3 years you have to pay the tax with interest. Now who will get the credit of this amount is again the question, because it is not sold to the job worker, it is not supplied to the job worker. It may come after 3 years also, but there is no provision which provides for any extension of time. There is no provision which provides for, even if it is whether the job worker will be entitled to claim the credit or not. Nothing is there written in this. It will be treated as a deemed to be supplied by the principal to the job worker on the date of supply. So it is going to create a problems, and most important is that for inputs 1 year interest is liable to be paid, and for capital goods 3 years interest is to be paid. So this is going to be a cost to the principal, because ultimately it is his own goods which is for its captive consumption. Now capital goods, as I said, 1 year time limit shall not apply to the molds, dies and jigs, fixtures and tools sent to a job worker or job worker. Then you got the credit. Now how it is to be utilized? Because most important is you got the credit in the bank. The ITC, it is to be utilized first against CGST. So CGST will be utilized against CGST and thereafter against IGST. SGST will be utilized against SGST and then IGST. IGST will be utilized first against IGST, then CGST and then SGST. This is to be utilized in order of preference, which I have given. SGST cannot be utilized for making payment of CGST and likewise CGST cannot be utilized for making payment of SGST. IGST can be used for making payment of IGST, CGST, SGST. Secondly, the most important thing is that this is a state-wise, because every state is a federal in the federal this thing. Every state is a different unit as such. So whatever CGST is paid for Maharashtra or IGST is paid for Maharashtra, that can be utilized for making payment of outward supply from Maharashtra only. If you are having excess ITC in SGST or CGST or IGST in Maharashtra and you have a liability in Gujarat, then you cannot transfer the credit of CGST, SGST, IGST to Gujarat state. It is not permitted. Every state is a different unit altogether. If you are having excess in Maharashtra, it will lie as it is in Maharashtra only. You cannot transfer it to Gujarat state. And the ITC can be utilized. It cannot be utilized for making payment of interest, fine and penalty, etc. It can be utilized only for making payment of taxes, not even RCM also. I think that they will come out. Right now it is not there, but I think RCM also it is not allowed to be paid. ISD mechanism, I'll just explain to an ISD mechanism. It's a head office of a multinational company, multi-unit company basically, which can take the benefit of whatever services they are availing at a head office. Say in Mumbai, if a company A is having a head office in Mumbai, they can claim the credit of all the services which are availed, which are either specific services to a particular unit and or common services like audit, head office is there, or advertisement or some other lease line, security, accounting services, consultant services. Now all these services, the credit can be claimed by the head office if they are paying for that. Even they can claim the credit of some specific services also. A distribution of credit will take place if the location of ISD and recipient like A in Maharashtra and he is having unit say in Karnataka and Tamil Nadu, then he will distribute the credit of CGST, SGST, IGST as a IGST only because it is different states. It's a destination based consumption tax. Similarly, if the location of ISD and recipient of credit they are in same state, that is in the Maharashtra to Maharashtra, then CGST will be distributed as CGST, SGST will be distributed as a SGST, and CGST and IGST will be distributed as a SGST and CGST. Because ultimately it is consumed in Maharashtra state only. So the consumption will, that is why the distribution will take place as a CGST to CGST, SGST to SGST, and IGST as a CGST and SGST. So this is basically allowing the services which are availed by head office to distribute to its units. Now, these are the conditions. These provisions are exactly picked up from the present standard credit rules. So I am not more elaborating on this. I am just keeping the main important conditions because this can be read through and this is already there for last couple of years in the statute. So you cannot, you have to issue the ISD invoices, without that it is not permitted. What you can distribute is the maximum amount of credit is available. So if you are having 100 rupees, you can distribute only 100, you cannot distribute 105. If any specific service is availed for any specific unit, like limited a company A, if they are, as I said, unit having in Karnataka and Tamil Nadu, and certain advertising services availed for unit in Karnataka, then that by head office in Mumbai, Maharashtra, then that entire credit has to be distributed to Karnataka unit only. It cannot be distributed to Karnataka and Tamil Nadu. It has to go to Karnataka unit only. Similarly, if there are certain common services which are used for all the units, then those can be distributed according to the turnover of those units in the state. So if the 60%, if the total turnover is say 100 crores, out of that 60 crore is contributed by the Karnataka unit and 40 crores is contributed by Tamil Nadu unit, then The common services credit, which are used by both the units plus head office, it will be distributed to those units according to their turnover. Like 60% will go to Karnataka and 40% will go to Tamil Nadu. So, and those units have to be operational in the current year. If they are not operational, then you cannot take the previous year's turnover. You have to apply the immediately preceding quarter's ratio to these things. Preceding month turnover to be applied. Then in the example which I given, say Karnataka 60% is to be distributed and the Tamil Nadu 40% is to be distributed. But due to inadvertent error, the head office has distributed 40% to Karnataka and 60% to Tamil Nadu instead of 40% to Tamil Nadu. In that case, the provision says that whatever is excess distributed to Tamil Nadu, that is 20%, that will be recovered from the Tamil Nadu unit with interest. Now, okay, it can be recovered from Tamil Nadu unit with interest, but what will happen to the less distribution which has taken place to Karnataka unit? Nothing is provided in the law. So that I think issue is there. Whether again a revised distribution will be allowed and it will be recovered. See, distribution is done by the head office, but recovery will take place from the unit which is utilizing it. So that is going to create some issues because and it will go along with interest. So wherever it is excess distributed, how it will be taken care of, that is still not provided in the law itself. Every RTP other than ISD or non-resident dealer. This is the inward supplies. As I said, inward supplies, the outward supplies, if you have earlier gone through the webinars, and as you read the GST law also, there is an outward supply to be prepared by every 10th of the month, of the next month. So the outward supply of a supplier will become an inward supply of the receiver. Now all he has to confirm it, he has to delete it, he has to whatever are required. So all outward supplies of outward supplies of the outward supplier will become an inward supply of his receiver. And if it is not there, then those also inward supplies which he has to put in. So inward supplies will be auto-populated by the system itself. And all the inward supplies which has to be done by 15th of the next, because by 10 the outward supply will take place, and by 15th the receiver has to confirm it, okay, he has to delete it, whatever he has to do it, he has to confirm it, whatever he has to do it, and he has to finalize his inward supplies. Because if somebody, if you have received the inward supply which has not been reported by the other person, then you can report that as your inward supply. That you have to do it manually. The outward supply which you are confirming, which other party is confirming, that will be auto-populated. But suppose if he has not confirmed any supplies, but you have that inward supply, then you can input those inward supplies manually, and then that person has a time to confirm that by 17th of the month. If he is not confirming it, then that will come to subsequently, but he has to confirm it. So by 15th it should happen from your side, and the other person has to do it by 17th. Now as I said, the details of modified, deleted and included by the recipient and furnished shall be communicated to the supplier concerned in the manner within the time. So by 17th it will be confirmed to him. If he confirms it, it is okay. If he doesn't confirm it, then what will happen, we will see that. And all the cases he has to rectify it within the time limit given, during which it is noticed. So any omissions are there, has to be rectified it, and all the omissions of credit note, debit notes, or any these things, invoices are there, inward supplies, has to be done by 30th of September. That is the time limit which you have seen, 30th of September of the following end of the financial year, or the filing of annual return, that is 30th of September ka returns you file by 20th of October 2018 for 16, 17, 18, or by 31st of December 2018, whichever is earlier. So by that date you have to account it for any rectifications, any modifications are there. Now any claim which you have input in, see, outward supply declared by other person which you are confirming, there is no issue to that effect. But wherever, so details of inward supplies to be matched with corresponding details of output supply furnished by supplier. So it has to be matched with additional duty of customs in respect of imported goods, that is IGST is paid, or duplication of ITC, that is any duplication. Suppose he has also shown it and you have again shown it that ITC is a manually, so that also will be taken care of. So inward supply matched with the corresponding outward supply shall be finally accepted and communicated to the recipient. So those which are accepted, communicated to the recipient. Excess ITC claimed on account of short or non-declaration of outward supply shall be communicated to both the persons. If not rectified in the month of communication, will be added to output tax liability for the month succeeding the month in which discrepancy is communicated. And OTL can be reduced if the sales supply is declared within the prescribed period. So, mind well, if you have disclosed something which is not disclosed by the supplier, then it will be added to your output tax liability, the recipient's output tax liability, not the supplier. Supplier has not declared it, so he has not confirmed it. So it will be added to your output tax liability in the next month, and you have to pay that along with interest. That is most important. Okay. But suppose you have declared it, then it will be reduced to accordingly. Any duplication of ITC claim communicated to the recipient will be added to OTL for the month in which it is communicated. So duplication of ITC can be straight away squared off. So that will not be allowed at all. And only on additional OTL interest is to be paid. On reduction of interest liability, on reduction of liability, interest will be refunded maximum to the extent of paid by the supplier. So if subsequently it is disclosed by the output tax liability by that person, supplier, then the receiver's output tax liability will be reduced to that extent, and even the interest, whatever he has paid, that will be refunded. Now this matching is going to be a real problem because everything will be done by the system. Right now also you are saying, I am talking and you are only listening, you can't do anything. Even if you are not liking or you are liking the thing. So similar things will happen in this case also. This is going to create a lot of problems because first of all, it will be auto-populated. You have to reconcile these things with your own data. On which parameters that will be reconciled, that is again a question, because you will have your own data which is there and the returns will be in a particular format. So that is going to create lot and lots of problems. Further, the claim of ITC, it's only the inward supplies. It's not the claim of ITC will be done by the government. Government is just will give the inward supplies, and all the inward supplies you have to identify whether you are entitled to claim the credit or not. So either you have to select all and then remove the ones which are disallowed, or you have to select each and every item. Now wherever in the volumes are invoices, volumes are inward supplies are very heavy, like say maybe in thousands or in lakhs. And in such cases, without system, even in normal case, I would say it is not possible. So it has to go through the system. Some interface has to be created in between your accounting system and the GSTN. Then only it is possible. It is not to be done manually because this is going to create a lot of problems. So you have to be very careful while doing this because ultimately everything is done by the system itself. Nothing is in your hand. In your hand, whatever is there, you have to manually put in. If it is matched with the outward supplies, it's okay. If it doesn't match with the outward supply, you will be liable to pay the interest. So you have to even follow up with your outward supplier because if he has not shown it, you will be liable to pay the interest, which is a penal actually in nature. But then this is what the provision is all about. So matching, reversal and reclaim of ITC is a dangerous provision. So to be very clear, this is the what to say flowchart presentation of the this one. It is very easy if you can see. If you look at this, it's very easy. But then, if it is not matching, then what are the steps you have to take? Supplier has to inform to the recipient. Recipient has to inform to the supplier. Need rectification. If he says no, no action is required. No ITC is allowed. If he rectifies it, the ITC is matched. It will be allowed. So this is all going to create, and this everything will be done by the GSTN network. So we have to be very careful while doing this. You have to input data and all these things are very careful. So the documents on the basis of which the credit is allowed is a tax invoice, as I said. And for advances, receipt voucher will be issued. Receipt vouchers you will not get any credit. But for sure it's already written in the section 28 that receipt voucher will be issued, and the credit condition itself provide that without tax invoice the credit will not be allowed. Those who are supplying the non-taxable goods or paying tax under composition, they are not they shall not issue a bill of supply, because anyway if they are issuing the bill of supply then the credit is not allowed at all. And the tax invoice and other documents should indicate the amount of tax which will form part of the price which is to be paid. So without the tax is shown separately, the credit is not allowed. Credit note, debit notes, where a tax invoice has been issued for supply of goods or any services, then the tax credit notes are to be issued, and the credit notes are to be accounted, because every credit note and debit note will have the impact on this credit eligibility. So if the credit note is issued, the receiver's credit availability will be reduced to that extent. If the debit note is issued, the uh, receiver's eligibility will be increased by that extent. And as I said, all debit notes, credit notes are to be declared by 30th of September of any credit note, debit note pertaining to the financial year so and so, 30th that financial year should be declared by this date. Either if it is not allowed, then it will not be allowed at all. So 30th of September and annual return, whichever is earlier, it has to be disclosed of. Goods returns within 6 months from the relevant invoice, then ITC is only reversed if the goods are returned after 6 months. Then on the transaction value you have to pay the taxes. So it is there. Anti-profiteering measures is introduced, the recent provision. This provision is there only in two countries out of I think 165, more than 165 countries have implemented GST. But only Australia and Malaysia is having the anti-profiteering measures. Why I taken this slide is because if you read the central government may by law constituting authority or interest and existing authority constituted under any law to examine whether ITC availed by any registered taxable person or the reduction in the price on the account of an reduction on the tax rate have actually resulted in commensurate reduction in the price of the said goods. So there should be actual reduction in the price of the goods. If it is happening because of ITC, then it should be passed on to the customer, and this is going to create lot of problems, because my competitor's price may be reduced because of ITC plus because of his economies of scale. I don't have those economies of scale with me. How I can reduce my price? So if the government compares those prices and say, you are not reducing, therefore you are liable for anti-profiting measure and penalty, then it's going to be creating a lot of problems. This is very subjective, but it won't happen in the normal general cases. It will have only in the specified customer goods where the ITC is not passed on or the price reduction is not passed on in the tax rates. Then only the questions will come. But this is really going to create a lot of problems. This is the first time it is introduced in the India. We have never seen such kind of law earlier, and but then this is what the provision is all about. Transitory provisions are there. Now, any provisions which are there, any credit which is there lying on 31st of, hoping that we have to hope only, hoping that it will come from 1st April 2017. If it comes from 1st April 2017, whatever credit is available on 31st of March 2017, the entire credit available in the return of the CINVAT credit, either under year 1 or year 2 or whatever it is, or ST3, that credit can be straight away taken under the ECL as a credit opening balance. So that credit is allowed, but it is available only in the returns, whatever is available in the returns, not in your books of accounts. Secondly, you have to ensure that the same is admissible as an input under the present regime also. That means you have to see whatever credit is lying, closing stock, is available in the earlier law also, and it is admissible in the GST also. This is going to be very difficult because your credit is indivisible, it may be comprising of many items. And once the credit is taken, it becomes indivisible, it's become a hodgepodge. So basically what you have to follow is whatever, you have to follow the first in first out method. Whatever first credit you have taken, that has been utilized. Whatever is remaining is basically coming from the last invoices. So go back from all the invoices which are from starting from 31st onwards. So those credit are pending, and thereby you can claim. And then you see the admissibility. It is going to create a lot of problems because you have to list down the entire credit which is available to you, the entire details of credit available to you, and you have to match certain things, that is whether the credit is available. Now taking the case, I'll just give an example. The repairs and maintenance credit is allowed under the service tax law now, under the CINVAT rules. But if you see the GST law provision which says that repairs is considered as a construction, and that repair is a capitalized, then the credit is not allowed. So if you have done any repair in this year, which is capitalized, under seminal credit rule, still you are entitled to claim the credit. But under GST law, you are not entitled to claim the credit. So that credit, though you are entitled to in the seminal credit rules, but not entitled to under GST law, therefore it cannot be carried forward. So that is going to create problem. But then that is what the law is all about. That is about the seminal credit. Similar thing is applicable to value-added tax and entry tax also. That credit also you can claim it, but it can be claimed not later than 90 days. I don't know why they have introduced the 90 days time limit. Immediately it should be allowed, and after 90 days, suppose if I forget to claim anything, then it is gone. Similar, that is applicable to my this thing also. The credit is not allowed for. If you have to see the both acts applicability for those credits which are in the transitory provisions. Then any capital goods credit which is under present law, you are entitled to claim maximum 50% and balance in the subsequent year. So in 16-17 you have claimed 50% in the first year, and balance is to be claimed in the next year. Now since that is available, that can be allowed in the subsequent year without any problem. So that is what the provision is all about. Now in this case of eligibility of ITC on inputs in stocks and section 69, category of persons, registered taxable person under GST who was not liable to register under earlier law, is engaged in the manufacturing of exempt goods under earlier law, works contract availing benefit of notification number 26/2012, and first stage dealer, second stage dealer, and registered importers. Now all these people who are not liable to claim the credit of excise duties or other taxes or VATs and all these things. Now for them, the taxes in respect of inputs held in stocks on appointed day, inputs in finished goods or semi-finished goods on the last day, they can be claimed subject to the conditions. I just go through the most important conditions that they should be used for making outward supply. And here you have to see that anti-profiting measure is included, because whatever credit they are availing, since they are not entitled to claim that credit, it has to be seen that that credit is passed on to the customer. This is going to be very difficult, because for a trader, normally, I don't see that they will pass on the credit, because it is very difficult for them to keep the track. But then the department has taken the power that if you don't pass on the credit of whatever credits you are entitled to, like a trader who has bought the goods with paying excise duty and all these things. Earlier he was not entitled to claim the credit, but now on stocks he is entitled to claim the credit, because when GST regime will come, he is liable to pay whenever he will supply those goods. He will liable to pay the duty. Now in that cases, he is entitled to claim the credit, but he has to pass on that credit to the customer. He has to see that the credit is available under the present regime also. Then he should be having the tax invoice or whatever in his hand. Secondly, he can claim only which are up to 12 months. Now, if you say 12 months means maximum up to 1st April 2016, whatever purchase you have made thereafter, those are only entitled to. Any inputs which are purchased and which are in stocks, any inputs which are in stocks and which are purchased prior to 1st April 2016, if it is applicable from 1st April 2017, then you are not entitled to claim the credit. Now, this is again a very provision which is harsh actually, basically, because if you are holding a stocks which are old stocks, then whenever you will sell it, you are liable to pay the GST on it, but you will not get the credit because it is earlier than 12 months. And the person has not claimed any abatement under the act, under the current act, under the GST law, not under the earlier law. What are the duties which are allowed as a carry forward? Excise duty, service tax, special additional duty, and all this. Now, the question is, the credit is allowed on goods. I don't know where is the question of paying any service tax on that. But then this is what the law says. These are the duties which are allowed as a credits. Now, this is the credits which are a registered taxable person who was engaged in the manufacture of non-exempted as well as exempted goods under the central excise, or is providing exempted services, or this one, then he can take the credit of entire credit which is available to him. There is no need to bifurcate now. If this is available for what to say, exempted goods, and this is available for, because ultimately subsequently is liable to pay tax on the entire goods. So whatever credit is available to him, he can carry it forward it to the these things. That is allowed. There is no need to bifurcate again a credit of mechanism that permission. Then this is again a good provision which was introduced in the revise only. It was not there earlier. Suppose any goods which are been moved from the factory on say 29th of March 2017, but it is received by the receiver on 2nd of April 2017. Then the tax will be paid under the old regime, but the receipt will be done in the new regime. In that case, whatever taxes are paid on this, because he will not take the credit, the recipient will not take it as a credit in his 31st March because it's in transit. Now in those cases, whatever goods are there, that can be claimed as a credit, but it is available only within 30 days from the appointed day. And it can be further extended for further 30 days. But if without, so maximum 60 days you can claim the credit. Beyond that, if any goods are in transit, you are not entitled to claim the credit. It is a good provision, making it very clarificatory. Any person who is switching over from composition scheme, so if any person is paying taxes under composition under the earlier law, and now is switching over under the normal scheme under the GST law, then whatever stocks he is holding on inputs, capital goods, inputs or semi-finished or finished goods, that can be claimed as a credit subject to the conditions which are there in my PowerPoint presentation and which are there in the section itself, which are self-explanatory. Any refund claim filed before appointed date to be paid, as I said, any refund claim which has to be claimed, it will be paid in cash, semi-credit refund claim basically, and if it is not paid fully or partially, it will be lapsed. This is going to create problems in case of the claims made under notification number 27 by 2012, because notification number 27 by 2012 provides that if the claim is rejected, then you can take the recredit of that amount. That is not permitted here. That credit will be lapsed, or it will be, if it is rejected, it will be lapsed. Now, my notification says you can take the credit, but transitional provision says the credit will be lapsed. So this is going to be again a dichotomy is there, and it has to be properly rectified in the final law. Now, any credit ITC on it is received by the ISD prior to the eligible date, that is appointed day, and the invoice is received thereafter. So the service is received on before 31st March 2017, but invoice is received after say 1st April 2017. In that case, that can be distributed, that credit, by the ISD. This is again a good provision. Those who are having, as you know, now you have to go state-wise registration. So every state has to take, now the service providers who are holding central registration, that central registration will have the credit which is actually available to all the people, to all the units. So that all the units credit is available, and that units credit is actually available or admissible to different units across the states. So those states credit now, since it's a GST, it's a destination based consumption tax. Now that credit in the cases of centralization, that can be distributed to those, transferred to those units and to that state. So they can utilize it against their liability. So suppose head office is registered here and in Maharashtra, and Maharashtra is not having any liability, say in GST era, then whatever credit is available in Maharashtra can be distributed to my units in say Tamil Nadu, Karnataka and all the places, because here I am having credit, and that has to be done within 3 months. So it's a good provision actually, because otherwise that credit will be lapsed if it is there in the centralization. Then whatever tax paid on the goods lying with the agents is to be allowed as a credit, so it's both provision is there. Similarly, whatever goods are lying, capital goods lying with the agents to be allowed as a credit, that is job worker, that is an GST law. Treatment of branch transfers, now this provision is there. In certain states there is a provision that whenever branch transfers takes place, there is an artificial reduction of input tax, there is a set off. Now since those stock transfers will be supplied in the GST regime where the tax will be paid on those branch transfers, so they are saying whatever reduction has happened, the credit refund of that will not be admissible or credit will not be admissible. So it's a loss basically actually, but then this is what the provision. Then this is again a good provision, like any credit. Suppose if you are if you are, this is a provision where in the service tax you have to pay within 3 months to your supplier. But suppose if it is not paid, say like a 31st of December invoice is there which is not paid within 3 months, then by 31st of March you have to reverse that invoice. Now once you reverse that invoice, it will not come into your credit balance as on 31st of March. Therefore, as per the first provision, it cannot be carried forward to next period. But whenever it will be paid, you are allowed to claim that credit as per the Senate credit rules. So they have given a further 3 months time period in the after the appointed day where you can pay that credit and claim the credit. So it is a transitional provision, good provision. But the only time gap is now you have to pay to your supplier within 3 plus 3, that is 6 months. Because if you are paying to him after 3 months, that is 30th June is the last date by which you should pay him. Otherwise, that credit will be disallowed. So these are the other transitional provisions. Any credits which is disallowed to you and you have paid it, then your other person, you cannot claim it as a again credit under the GST law. Similarly, you have paid something as a arrears of taxes and you want to claim it from your supplier that okay, I have paid these taxes, now you give me these taxes and you can claim the credit. That is also not allowed. Even you have paid certain taxes under revised returns, that is also not allowed as a credit. Now with this I think I have completed almost the portion. According to me, GST is a grow and share together, so we all should grow and share our kitty with the government, because government is indirect benefit of 18% partner in our business or our profession. This is just the sharing of thoughts. I am the German writer Anne Frank, she has said that no one has ever become poor by giving. So no one has ever become poor by giving, but everybody becomes richer by sharing. And I am also opinion that by sharing my views, because we are on the same platform, it's a new law, sharing my views, we are richer both, we are both of us. Thank you very much for patience listening. If any questions are there, eh? कितना है? पाँच है. Okay. Which one? Bhaskar Rao, his question is soft copy versus hard copy of invoice compulsion. Please explain some information. See, they have said possession of the invoice is required. Now, this is a digital era what we are talking about. So, according to me, even if you have a soft copy, that will be taken care of. So, even if you are having a soft copy, I think because in future, these all invoices will be signed through digital signature and all these things. Even registration also you are signing digitally. So, soft copy will be taken care of. You have to keep it in that electronic mode. That is most important. I think, sir, the further rules will come into picture when we will progress the GST law. Then the Rahul Puranik, sir, the time limit of 18 months for availing ITC is to be seen from the date of invoice or 1st April of relevant financial year. See, it is to be seen from the date of invoice. 1st April of irrelevant year is in, I have given the example because I have given said that my invoice is from 1st April. So if your invoice is of say 31st of March 2018, then you will have time limit of only 6 months. So the time limit of not 18 months, you have to calculate the time limit from the date of invoice till 30th September 2018, that is 30th September of the next year, or annual return is the last date. That is you have to come. Hemant Shah, sir, what if we are registered dealer claiming set off presently and register as a composition dealers under GST, the position of credit unclaimed, can we reverse the same? If yes, under which provision? We are registered dealer claiming set off presently and register as a composition dealer. See, if you are already as a your claiming set off under the present regime under VAT. Now VAT, there is no requirement to carry forward. You can claim the refund straight away. There is no need to go for composition, because and if you are going under composition under the GST regime, then you are not going to claim any credit. That is gone. So, and that is you have seen in that I think one of the section I have seen all fixed first stage dealers are there or exempt supplier are there. In that case, they have clearly said those you are not claiming under composition. So in this case, if you are claiming any VAT set off, you can go for refund straight away under VAT instead of going for composition, because there it is straight away allowed. Yes. Thank you very much for patience listening.
Thank you, Bharat Bhai, for nice presentation. Before coming to thanks, there is some announcement. First is our next webinar is on 10th of January. That is on time of supply by CA Manish Gadia. Timing will be 6 p.m. to 7:30 p.m. So please note that date, 10th of January 2017. Time of supply by CA Manish Gadia. There is another announcement. IDT committee has already announced RRC at Goa on 26, 27 and 28 January 2017. Best faculties are available to address us on GST and other laws. Please enroll if you have not. For further details, please visit CTC website www.ctconline.org. Coming back to vote of thanks, Bharat Bhai, we thank you for addressing us on ITC on inputs, input services, and capital goods, ITC in respect of job work, input service distributors, transitional provisions. Let me tell you, he is the best speaker available as on today to take us through the ITC credit provisions under model GST law. Thank you, Bharat Bhai. We wish you all very happy learning through such webinars. Thank you all. Good night. Thank you.